Good morning, all of you. I am Dr. Yadu Rao, working as an assistant professor in Government Meera Girls College, Udaipur. And from today's session, we'll be starting security analysis and portfolio management. But before starting that, we'll try to understand some of the basics of investment. Because some of the students, they believe this subject security analysis is quite difficult. Yes, it is difficult because you cannot study this subject on standalone basis. You need to go through many subjects and topics and some concepts. At the same time, practical knowledge is to be there to understand the subject. So let's start with investment before going into the depth of security analysis and portfolio management. So the objective of today's lecture is to understand the meaning of investment. We'll try to see the expectations of investor and we'll try to understand the basics of investment. So today's session is going to be theoretical one. So what is investment? By definition, investment is the sacrifice of current cash or resources and expectations of returns in future. That means in investment, you sacrifice resources at present. On the slide, you can see there is a timeline. You can understand the timeline. T0 means present, T 1 year means this is the time of realization, or you may say after 1 year you are going to realize the investment. So by definition, if you are investing at T0, that means you are sacrificing the funds available with you, or you may say you are detaching money. For example, rupees 1 lakh, and now you are setting your expectation, because if you are not setting your expectation, that cannot be an investment. So if you are detaching your fund without any expectation, that can be a social act but cannot be an investment. So if you are sacrificing rupees 1 lakh in expectation of, for example, 10%, we will see later how this 10% comes into the picture. But till now, we need to understand, yes, expectation is to be there, and the expectation of this investor is 10%. That means at the end of the year, he is trying to earn in total rupees 1,10,000, or you may say 10% of return. Now there is a possibility that he may earn only 1,08,000, that means only 8%. Or in one good condition, he may earn 1,11,000 total, or you may say 11% of return, where he was expecting only 10% of return. So in second option, he is adding some value in his investment. And there may also be a possibility to earn only or to receive only 1,05,000, where he is earning only 5% of return. Or so many possibilities may be there, but we can see one thing which is really very important, that where we have any expectation, we have some sort of risk. And what is risk? Risk is the variation in return. We are expecting 10%. If we are going to earn 10%, there is no risk. But in real market conditions, what happens when we expect something, we do not in general receive the same amount of return. So this is the problem with investment, that we need to set up our expectations, and expectations in general rarely meet out. So this is the possibility. These are the possibilities, and element of risk is always there because of uncertainty. Future is uncertain. So this is just a definition of investment. So you can get little bit idea of investment by looking at this timeline. Now we need to understand the basic of financial management. Okay, now you can see on this slide that there is a bank, there is a company, there is an investor, and there is an investment opportunity. Now investor is a person, he is having investable fund, and at the same time he is having two opportunities. One to invest in a bank, another one is to invest in a company. And he believes if he invests in a bank, he is going to get a return of 10%. Now he has decided not to invest in a bank. Instead of bank, he is investing in a company. That means now his minimum expected rate of return would be 10%. Why 10%? Because 10% is his opportunity cost. If other things will remain the same, his expectation will not change. So from the viewpoint of an investor, his expectation is the minimum expected rate of return or minimum required rate of return. Now he is sacrificing his money in favor of company. So his expectation will now become a cost of capital from the viewpoint of a company. That means the cost of capital will become 10%. Why this cost of capital? Because this man is contributing in the capital of a company, and ultimately company should go with the intention of shareholders wealth maximization, and shareholders wealth maximization can be achieved by giving or by satisfying investors expectation. So now company cannot earn by putting the money in its pocket. It has to invest it somewhere. And if we say the company is investing in the investment opportunity, that implies that company is going to get more than 10% of return. Because this is the only solution to pay back to the investor. So for example, if this investment opportunity is going to give 12% of return, or almost, for example, more than 10% of return, this opportunity may be termed as the growth opportunity. But there are certain conditions. If this investment opportunity is not going to give a return of 10%, or maybe it is going to give a return of 8% only, then what company should do? Now company should not retain the money of its investor. It should pay the money back with the help of dividend. So these are the three important decisions which we are supposed to take in financial management. One is financing decision, second one is investment decision, third one is dividend decision. Now to establish the link between the financial management and security analysis, we need to look into the financing decision. Now financing decision, what company does? Company chooses what kind of investors will invest in a company. That means in financing decision, company decides the debt equity ratio. What amount of debt will be there in the capital structure, and what amount or what proportion of equity will remain in the capital structure. Well, maybe company is going to get trading on equity there, then there's a financial leverage which company wants to enjoy, whatever the case may be. But in financing decision, this is the only problem that company needs to go to the solution. Now, if we look from the viewpoint of an investor, in security analysis, investor chooses the company to invest in. So this is the basic difference in financial management and security analysis. In financial management, corporates think about themselves. In security analysis, investors think about themselves. So in totality, both the things are one and the same somehow, but the tools that we use in security analysis is different. Tools we use in financial management, they are a bit different. But at the same time, we need to have some idea of financial management as well. Okay, so in next session, we'll try to discuss about risk and return, and we'll also discuss some important concepts of security analysis and portfolio management. And before that, we will again try to go into some basic concepts and understanding of basic concept, because there's a long way to go, and I hope within 10 to 15 sessions, I will try to cover your whole syllabus. So thank you. Thanks a lot. Have a good day.